Okay, tonight we're going to talk about plant assets, natural resources, and intangibles. There are several learning objectives. If you want to pay attention to the slide that should be on your monitor now, we are going to learn to measure and account for the cost of plant assets. We're going to distinguish a capital expenditure from an immediate expense. We are going to look at measuring and recording depreciation on plant assets, looking at the effective disposals of those plant assets, the journal entries, how does that affect our books. We will apply GAAP for natural resources and intangible assets, explain the effect of asset impairment on financial statements. That's going to just be real brief because that's really almost out of the scope of an introductory course, but part of it you need to understand is out there. We're going to analyze the rate of return on assets and look at how long-lived assets affect our cash flow. First of all, we have our long-lived assets. Those examples are our plant assets, which are land, building and machinery, equipment, furniture and fixtures, land improvements. We might have vehicles, anything that has a life longer than a year, and that we're going to look at spreading the expense of the cost of that over its useful life. All plant assets are depreciated. They're on the balance sheet as these land building account, and then we will have a depreciation expense to go along with everything except land, which does not depreciate. We'll have natural resources, and natural resources actually deplete instead of depreciate. You use them up through cost of goods sold. And intangibles are actually amortized instead of depreciated. It's the same type of process. You will hear sometimes in companies, if you go out to work, you'll hear them calling depreciation amortization sometimes. They'll say we're going to amortize our capital assets instead of depreciate, but they really mean the same thing when they say that. It's a little bit of misuse of the terminology, but the process is the same. To look at the cost, we have to remember that when we are figuring up what the actual cost of the asset is and what we record in that asset account, such as for land or for a piece of equipment, it's everything that it cost us to get that asset to our place of business and ready to use for its intended use. So that would include the purchase price, any taxes we might pay, commissions, if we had to make a special foundation to put something on, or if we had to do specialty training to our employees, anything to make that asset usable to us as part of its initial cost that gets recorded in the asset account and is capitalized. For example, if we look at land, we have a purchase price, whatever we paid, cash plus any note that we borrowed. We might have brokerage fees, survey fees, legal fees. Sometimes you have to pay the back property taxes when you buy a piece of land, and then any expenditures for grading or clearing and removing unwanted buildings. So if we purchase a piece of land for the sole purposes of having the land, perhaps to build a new building on, and it has an old building on it, it has to be torn down, the cost of tearing down that building is part of the cost of the land. And therefore you don't get to depreciate it. It's also, if you would tear down a building and you got any scrap out of that building, then that would, of course, the scrap amount would reduce the cost of the land. So you can get a little bit back off of it when you have to pay to have a building torn down. So let's look at a quick example, because you do have to do a few of these either in your quizzes or in the practice. I can't exactly remember which one, but if FedEx signs a $300,000 note payable to purchase 20 acres of land for a new shipping site, they also had to pay $10,000 for real estate commission, $8,000 for back property tax, $5,000 for removal of an old building, and a $1,000 survey fee, and $260,000 to pave the parking lot. They paid all of this in cash. What is their cost of the land? Do you see anything there that would not be a cost of the land? Okay, you're right, Blue. The parking lot pavement would not. And also, I had a couple of questions here. Does it matter that the cost of the land is more than it's worth? And due to the expenses to get it ready, okay, so you're saying that due to the expenses to get the land ready, does it make it more than what it's worth? The cost of the land, the historical cost, is whatever you paid for it, or whatever you paid to get it ready for use. It really doesn't matter if you pay more. I don't know how you determine what it's worth. I mean, it's what it's worth to you. If you pay more than appraised value, absolutely, you still record it at what you paid for it. Yeah, the slides probably move really slow here. I don't know if it would be better for me to the slides are just probably going to be behind, and I will then post the slides. Right. So does it make a difference based on appraised value versus worth? Yeah, appraised value versus worth. I would say that the worth, what it's worth, is appraised value, right? Appraised value would be what outsiders who specialize in knowing what something is worth come in and they appraise it, and that is your value. But you can pay more than appraised value. Now, if you've ever tried to borrow money on a house and to buy a house and you needed to borrow more than what the appraised value was, then the bank probably wasn't going to loan it to you. But if you're paying cash for something, you know, clearly, if I wanted to pay you $1 million for a $100,000 piece of land and I wanted to pay it to you, you'd be happy to have it, right? Yeah, actual costs. So cost, we recorded at actual cost. That's its historical cost. Yeah, Shad's listening. He'll take $1 million for $100,000 worth of land. So it's really what we pay for it. It would not be a smart business decision to pay a lot more for something than what it's worth. And different things are worth more to some companies. If there's a really great site that has a lot of traffic, a huge traffic flow, and what you're wanting to do is sell some type of business where you need a large volume, or have a business where you need a large volume of customers to be successful, then absolutely that's worth more to you than maybe even an attorney's office who didn't need that huge traffic flow going by them to get the type of business they needed. So if you were a fast food restaurant, you might pay more for a piece of land than an attorney would, just because of the traffic patterns and the number of people who would have access to your business easily. Okay, so does it matter when you list your actual assets? Don't you have to give an accurate representation of what your assets are, regardless of the cost? As in, do you adjust cost of property? Okay, at the end of the chapter, it starts talking about impairment of property. So at that point in time, if the value of your land goes down, it's not worth what your, not just your land, but your assets. If they are impaired, they're not worth what you have on your balance sheet, then absolutely, you do have to do some adjustments for your assets to be in compliance with GAAP. Again, that is something, it's mentioned in your chapter. A very simple example is shown near the end of the chapter of how you account for impairments in your assets. But when you first buy that asset, you are going to record every cost that you have toward that, regardless of if it's more. And that's okay. I want you to ask questions. It makes a lot of sense to ask the questions as they come up, and when we just won't have to spend as much time on it when we get to the end. It's really, 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 they're really good questions that you're asking. It shows that you are thinking and trying to understand how this can all work, because you're right, we don't want to overstate our assets. But if it's what we actually paid for it, it is a cost of doing business. Okay, so on this example, it was truly the paving of the parking lot that did not get included. When we pave that parking lot, that is a land improvement or property improvement that gets depreciated off differently. So we're still going to just record the total cost as land, and then our note and our cash that we paid. Buildings, just like land, anything it takes to build that building, the architecture fees, the building permits, contractor charges, payments for material labor. And this is an interesting one that that sometimes gets missed. The interest on money borrowed to finance construction. Obviously, if you are paying interest on a mortgage, that is an expense if that's a business mortgage, but that's after the building is already in use. If we are building a new building, then it is not, or remodeling a building even, the interest on the money that we have borrowed toward that building until we occupy the building is actually capitalized, or means added to the cost of that building. And then it is depreciated over its useful life instead of just being expensed in the period. And equipment's the same way. Anything it takes to get there, any cost of special platforms, anything it takes to get that equipment ready to use. As I said, even training of the employees to get ready. Training of the employees to put the equipment to work in the first place, not subsequent new employees. So we would have a land improvement. Those would be your driveways, your signs, your fences, your sprinkling systems. These also depreciate because they lose value. You put up a fence and it might last for years and years and years, but eventually you're going to have to replace it. The same goes for if you put in a lot of landscaping. You can depreciate your landscaping. We have leasehold improvements, which if we have a long lease on a property, maybe we have a 20-year lease, and we are going to do some improvements on that for our purposes, then we can depreciate those leasehold improvements over their life as well. I'm up to a lump sum or a basket purchase slide right now, and I don't know if you're that far or if you've had a chance to look in the book yet. But I'm more concerned about you hearing the words and seeing how this can work. I always tell students when we're doing something like this and they look at me like I'm crazy sometimes, and I say, this is a math problem. You don't see it yet. Okay. But it just says lump sum or basket purchases. So we'll set here a minute, or what I can do is, rather than use these, I'll leave the slides up, but what I can do as well is pop up an Excel sheet at the bottom so that I can show you examples on that. I think the Excel probably pops up better for you. Oh, you got it now. Good. And people probably get it at different speeds, right? At any rate, if I have a lump sum purchase, I might do something like I buy land that has a building on it, and the combined purchase price is, let's say the combined purchase price for buying land and a building, I pay $100,000 for it. Let me make that a little bigger. Okay, so if I buy land and building and I pay $100,000 for it, I go out and I bought it for cash. I paid $100,000 cash. We'll just add some details in here. I went out and I had this appraised. When I had it appraised, the land came back at $75,000 and the building came back at $50,000. So that's appraisal, fair market value, okay? How would I record this in my journal entry? I can't just record the land and building together because buildings depreciate and land does not depreciate. So I need to have an amount for my land. I need to have an amount for my building. And I need to have my cash amount. My cash is clearly $100,000. It's what I paid. It's verifiable. I know that's exactly what I pay. I can't record my land at $75,000 and my building at $50,000, however, because then my debits don't equal my credits. That's right. Katrina, you popped in and you said we're going to divide it by the total. So we're going to sum this up. And our total is 125. Right? I need to get a percent. So I'm going to divide my 75 by 125. I'm going to divide my 50 by 125. And so I have 60% and 40%. So because I can do those numbers, I like to use the easy numbers in my illustrations because I can do it in my head easy. That means my land is going to be $60,000. And my building is going to go on the books at $40,000 based on fair market value. Now this was an example of where I paid less for the land than what it was appraised for, but I really could pay more than what the land was appraised for, and it works the same way. And I think most of you, the slide finally made it up for. So if several assets are purchased in a group at one price, the total cost is allocated based on their market values. And this is called the relative sales value method. If you're accounting majors and you go on, you will see the relative sales value method used in other situations as well, which is kind of why it's being pointed out to you now. So when you see it at some later point, you don't think, I've never seen that before. You may not remember it, but it's really just this simple to calculate out. And this was just another example of basically what we just did, only there were 3 items. We were looking at a land, building, and equipment. So I'm just going to go on through that one. And I know it'll take you a while to catch up with your slide, but okay. So my next slide that I want to talk about is distinguish a capital expenditure from an immediate expense. Capital expenditures are anything that increases the asset's capacity or extend its useful life. To capitalize, I keep using the words it's capitalized. I've said it probably 100 times already tonight, but if something is capitalized, it means that the cost is added to the asset account and is not expensed immediately. We capitalized our land, even though we're not going to depreciate it. We capitalize any building. And then we will capitalize things that we might sometimes just think of as being a repair, but they become extraordinary repairs. And these are things such as a major engine overhaul because it extends the life of our equipment, or we might modify the body of a truck for use if we were This could even include if I had an old pickup truck and I decided to take the pickup bed off of it and put a flatbed on it so that I could more easily haul the welders around, or maybe I put a tool bed on it so that I can use it as a tool truck in the field. Anything that I do like that is changing that truck for another use, and therefore that is a capital expenditure. I would not be able to write, if I spent $10,000 making that change, I could not use that all as an expense in 1 year. I would have to determine how many years I was going to use that truck and spread the cost of that change over that truck's new useful life. So ordinary repairs, however, are things such as just changing your oil, or if your transmission goes out and you have to put a new transmission in, if you have to put new tires on your car, which even though hopefully they're going to last you more than a year, tires are something that are not considered a capital expenditure. It feels like a capital expenditure these days, but it's just not something that in the accounting world is called a capital expenditure. It's just an ordinary repair, and so those are recorded as an immediate expense and come off of your financial statements as a period expense. So if I put new tires on my car in May, then that's going to be a total expense for the month of May. We record depreciation on plant assets. That means that we're going to allocate the plant asset's cost over its useful life. We match that expense against the revenue that the asset is helping us to earn each period. We're following the matching principle. We have to do this because of GAAP. Depreciation expense is reported on the income statement, whereas accumulated depreciation is a contra asset account, as we've talked about in earlier chapters, and offsets the asset on the balance sheet. And again, land is not depreciated. Well, actually two things that sometimes people think about depreciation is that it's a process of valuation, because what we actually end up with on our balance sheet is a book value, and that's not necessarily what that asset is worth, fair market value, when it's sitting out there as our book value on our books. And sometimes people think that depreciation means that we're setting cash aside to replace those assets, and that's not what we're doing at all. We have already put out the money to buy that asset, and now we are spreading that cost over the next several years until that asset is no longer useful to us. And I've deleted a few slides here, so this may look a little funky, but we've already talked a lot about cost. We talked about how you get to the cost that we are going to start depreciating. And the next thing we need to know in order to calculate depreciation is the estimated useful life. The estimated useful life can be measured in more than one way. It can be the length of service expected from using the asset. That may be years, units of output, miles, or some other measure. Some machines will run a certain number of parts before they historically start having problems, so that would be units of output. Vehicles, it's easy to measure in miles. Some equipment, you run it by the hour more than by the mile. It's, one thing that we know out here in the farm world, me and my family and all my neighbors know that when a combine hits 4,000 hours, then if you can afford to trade, you should probably trade, because it tends to start costing you more in repairs, and you seem to be spending more downtime than runtime. And you also need to know the residual value. What is residual value? You may have seen it called scrap or salvage value, what this piece of equipment is worth after its useful life is over for you. Now, it doesn't mean you necessarily get rid of it at the end of its useful life. I mean, hopefully we are estimating the life of our assets accurately, and if we see we're going to keep something longer, that we are extending that depreciation over that longer life before it's just sitting there at a carrying value on our books, or a book value on our books at, say, $10,000 for the rest of its life. That's basically how it does work. If I have an asset that depreciates down to its residual value, then it sits on the books at that value until I dispose of it or sell it or trade it. Another term that we need to understand is the depreciable cost. That is our assets cost less our estimated residual value. We need to be careful when we're working on some of our problems, because it will ask you for things such as depreciable cost. Then it will ask you for the book value. Well, the book value is the cost before you take off your residual value in that first year. And then after I've done some depreciation, it's my cost minus my accumulated depreciation, or all my year's depreciation added up. So here's just a little quick example if you can see it. If not, you can probably, I'll read it and you can probably rationalize how this works. If I have a truck that cost me $41,000 and I had a residual value of $1,000, that makes my depreciable cost $40,000. If I'm using straight line depreciation, its life would be measured in 5 years. If I'm using units of production in this case, I was going to say that it will last me 100,000 miles. So I have a truck with depreciable value of $40,000, estimated useful life 5 years or 100,000 miles. That's where we're at. With straight line depreciation, I just simply take my depreciable cost and divide it by its useful life. So my truck is 41,000 minus 1,000 divided by 5, which equals 8,000. Because this is straight line, then every year it'll be $8,000 per year for 5 years. At that point in time, that totals 40,000. So 41,000 sitting in my truck account less my 40,000 sitting in accumulated depreciation gives me only $1,000 carrying value or book value. So as an asset is used, its accumulated depreciation increases and its book value decreases. Just what I said in different terminology. So here's an example. See if you can do this one real quick for straight line. We have a machine that costs $10,000 with a useful life of 5 years. And a residual value of $2,000. It was purchased on January 1st. What is its straight line depreciation for year 1? Okay. I have a couple of 1600s, that's right. What if I bought this on July 1st and my year ended on December 31st? How much would I depreciate that first year? Right. Blue jumped right on that one. Yep. There you go. That's right. If it's just for part of the year, then I wouldn't take the whole amount. And that would not matter which depreciation method it is. In this case, this straight line is 1,600 for the year, 800 if it were for half a year. If it were for 4 months, it'd be 400. So you guys all have the straight line down pretty good. Units of production. We have our fixed amount of depreciation. It's assigned to each unit. We determine a unit cost, and once we have that unit cost, we just multiply it each period by the amount that it was actually used. This is lots of times popular for vehicles for that reason, because it seems to be a clearer measure of how that vehicle is being used. So to get our unit cost, we take our cost minus residual, divide it by our 100,000 units, and that gives us 40 cents per mile. And here is an example then of how that depreciation schedule would work out. I do know, and again, thanks to one of your classmates, it's sitting here online, in fact. I know that there's a problem in your homework that will catch you on this units of production. Am I right? It'll catch you on your units of production because you run out of depreciation. Yeah, but you run out of depreciation in your last year. And why is that? Because you shouldn't, when you're using units of production, it should come out perfect. Well, in the My Accounting Lab problem, it's a rounding. You have to round to the nearest cent before you do your calculations, and by rounding up to the nearest cent, and I suppose they're all different. They could be different problems. You could have to round down, in which case you would be under for the last month, but you can't go over. In this case here that we're looking at, we wouldn't be able to go over our $40,000 total. So if I get to that last period and my depreciation when I multiply it by the unit cost comes up to too much, I have to adjust downward for that. So that'll save you all some time to know that. So just pay attention. One of the problems, because of rounding, causes you to have to adjust your yearly expense in your last year on one of your problems. But all we're doing is, once we have our rate, we use the same rate times the number of actual miles. It's going to total up to 40,000, because 40,000 is our depreciable cost. And the depreciation entry is always the same. Depreciation expense and accumulated depreciation for whatever our asset is. In the units of production, it will be a different amount each year, or could be a different amount each year. Double declining balance. This is really fun. Double declining balance is twice the straight line rate. It's an accelerated depreciation method. It writes off a larger amount of the asset's cost near the start of its life. And again, as I said, it's twice the straight line rate. It's the most frequently used accelerated depreciation method, and it actually computes our annual depreciation by multiplying the asset's declining book value at the beginning of the year by a constant percentage, 2 times the straight line rate. That's a bunch of garbage sounding if you've never done it, but it's not that hard, but there's a couple of things you have to remember. We have to remember that to get twice the straight line rate, it's 1 divided by the useful life in years. In our example here, that was a 5-year life. 1, and what this 1 represents is 100%. So 1 divided by 5 is going to give you 2, or 20%. 20% times 2 would give us 40%. So that's our constant rate. As I said, we would multiply by a constant rate. The double declining rate would be 40%. If it asks you what the straight line rate, it is 20%, 1 divided by the 5. You will notice the probably most important thing that you need to notice here. Let me see if I can get a Okay, there's our rate. What I wanted to point out, and I was trying to get, there it is. Is this 41,000. You notice that what we're starting with, the cost, we're not taking the $1,000 off first, the residual value off first. First year, our book value is clearly 41,000. It would be under any method. So we take our 41,000 times our 40%. Our first year's expense here is the 1640. Our accumulated depreciation at the end of the first year is 1640. Our book value goes down by I'm saying 1640, but 16,400. And that's going to drop our book value of 41,000 minus that 16,400. The next year we multiply by the 16 or the whatever 40% times the 24,600 to get the yearly expense of 9840. We add that to our 16,400 and down through the process. In our last year, however, we cannot go below our $1,000 residual value, so you have to remember to watch that amount and not go below. So 40%, if it takes you below the 1,000, then you can't take the full amount. Okay. So remember to watch that. The final year depreciation is a plug amount. Whatever it takes to reduce us to the book value of $1,000. In this case, it was more. Sometimes it's less. And I have a question of why would it be useful for a company to use the double declining balance? The reason would be that we get to take advantage of it in the earlier years. The expense of it in the earlier years, it reduces my tax liabilities. So maybe I had purchased this, by purchasing this piece of equipment in January, I spent this $41,000 cash in January to buy this piece of equipment. And this actually reduced my tax liability for the year on this $16,400. So if I was in the 30% tax bracket, then that's going to have saved me over $5,000 here. I'd have $5,000 more worth of cash in my pocket that first year that I had spent all of that money. Another thought process is that on some assets, you use them heavier in the first years that you buy them. I like to think about, I mean, if you have a new car and an old car sitting out there in your driveway, which one do you want to drive the most? You may be saving your new car, but if you had your choice, wouldn't you always hop in the new car and take off? And I say that's what happens in businesses who might buy delivery vehicles, like furniture stores or something. If they have a newer vehicle and an older vehicle, delivery vehicle out there, their delivery people, if they've got a chance, are going to hop in that new vehicle every time, and therefore it's getting more use in its earlier years. But there are advantages. Does that make sense, Kiana? Kenyana, I can't even say your name tonight. Okay, good. And I would tell you, as being someone who takes advantage of depreciation, and I was, again, I may have said this last week, but we were having a conversation in the 5 minutes I saw my husband this morning before I left for work about, crops are doing pretty good this year. We probably need to spend some money to keep from paying so many taxes. It's kind of really frustrating when you end up paying out a $30,000, $40,000 income tax bill when if you had purchased something, you could have done away with that. I mean, I could buy a new truck and stop that. I just wouldn't have to pay it at all, and I'd have a new vehicle. The money'd still be gone, but I'd have a new vehicle instead of paying the government the taxes. So, and that's done by accelerated taxes. Yeah, makes, you just, when you're in business, you have to figure in how depreciation can help you. But honestly, keep this in mind, I'm saying that, but keep this in mind, you need to use the depreciation method that best reflects how that item is being used. You shouldn't look at it just as a tax advantage after I just sat here and told you how I use it as a tax advantage. But at any rate, that's not necessarily the goal. Okay, so we got through that. And here's just another example. And again, I'll upload these slides for you if you want to look through them. And they have notes that I'm not necessarily reading verbatim or anything like that. But I can upload these in Blackboard for you as well next to the video. And that way, if you want to review the slides so that you can actually see what's going on, that's fine. And you can read the notes. So here's some examples of when the methods might be best. So straight line would be best for plant assets that generates revenue evenly over time, and it best meets the expense recognition principle. Units of production, best for assets that wear out because of use. That would be the number of miles or the number of parts that you run through. And double declining, best for assets that generate more revenue early in their useful life. Okay, so things that you are running more because they're more efficient or something early in their life are a good option for double declining, not just for tax purposes. And here's comparing the actual depreciation levels each year. And you see it's always 40 total when you're to the end. I mean, in this case, it's 40 total because it was a $41,000 asset with a $1,000 residual value. It's just a little graphic. Most companies use straight line depreciation for their books. Here's something that you may or may not realize. You would realize it more after you've read the chapter. But you do one type of depreciation for your books, and lots of companies use straight line because straight line's easy. Doesn't take a lot of computation to do straight line depreciation. You actually compute it once, and that's your amount, and you just keep on going until you're out of depreciation for that asset. But you have a different depreciation method for your tax purposes. So how you're recording it on your books really has little weight on your tax depreciation. And this is just another little sample depreciation method. Depreciation schedule. They have you do depreciation schedules in your homework. So again, I'll upload this PowerPoint. It might be useful for that purpose, although I think you can figure it out in your homework. And they're just doing a units of production. It's a good example, but it takes a long time to load, and I'll be through it before you ever see it, most likely. And then a declining balance. And we can look at a couple of these in Excel too before we're done for the night. Okay. Other things that we need to think about with plant assets, they do have long lives. The depreciation affects their income taxes. Gains or losses occur when those plant assets are sold. And international accounting changes in the future that are coming up with the IFRS, which I mention every now and then, the International Financial Reporting Standards require a little bit of different accounting than U.S. GAAP currently does. So accelerated depreciation provides fastest tax deductions. Tax deductions decrease tax payments. We should be understanding that. And tax savings can be reinvested in the business. So if I don't spend $8,000 on my taxes, then I have $8,000 more to buy something else with, or to improve something in the business. So here's a little, and it's in your book on Exhibit 710 as well, but it's a little exhibit for depreciation for tax purposes, and it shows how for a straight line it might be $8,000 for the year, but my accelerated method that I'm using for taxes is $16,400, and it shows that I have an actual, in this case, between these two methods, based on my income taxes, I actually end up with $2,520 more to spend. Now, that's when we're looking at a difference of a little more than $8,000. If this were millions instead of thousands, then look how much money that would leave us to, start adding zeros, and this becomes much larger very, very quickly. And I had pointed out a little earlier in the straight line, and you all jumped right on that and knew that you had to divide it. But if we have partial years, then we have to compute the full year and then figure the partial year from that, or we can just divide by months. If we know we're going to record, if I'm going to record a 5-year life asset, and I know that I'm going to record my depreciation monthly, then instead of doing 5 years, then why would I not just divide by 60 months, and then I have my monthly depreciation anyway, and it all computes out the same in the end. But I, of course, have to record the partial years, no different than recording my accrued interest. I have to know for how much I need to match against that revenue that's been earned. I can also change the life. This is one thing I mentioned earlier as well. If I had thought that an asset was going to last me 5 years, and here I'm in year 4, and I decide, nope, it's going to last me another 3 years instead of just another 1 year. At that point in time, I go from my actual book value at the time, and I spread the rest of its cost out over the new useful life. This is called a change in an estimate. We don't have to go back and do any prior period adjustments for that, because it's depreciation at best is just an estimate. It's our best guess from the minute we bought that asset and we said it's going to last me 10 years. Well, things change quickly, and it could last us 20 years, or it might last us 3. So as soon as we realize a change is needed, we should go in and change that estimate and expense it off to match it against the revenue the best we can. Here's a quick example of that. A high school had purchased equipment for $510,000, which was estimated to have a useful life of 10 years with a residual value of $10,000. Depreciation has been recorded for 7 years on a straight line basis. In 2014, which was year 8, it is determined that the total estimated life should be 15 years with a residual value of $5,000 at the end. So the original life was 10 years, and then they decided it should be 15 years. They're in year 7. They were in year 7. In year 8, then they decided, so how many years do they have left, and how much depreciation do they need to record? What is the correct journal entry to record prior year's depreciation? Well, straight line. So 500,000 divided by 10, that would be 50,000 a year, right? and then calculate the depreciation expense for 2014. So 7 years have been passed. The $50,000 times 7 was $350,000 has already been used up. The equipment cost of $510,000 minus its accumulated depreciation of $350 gave us a net book value of $160,000, and then we are going to spread that $160,000 over the remaining 8 years from year 7 to year 15. So 155,000 divided by 8 means we would depreciate 19,375 per year. So if we have a fully depreciated asset, it sits on our books under the equipment account at $60,000, for example, in this example, and its accumulated depreciation is $60,000. Its book value is 0. It just sits there until we dispose of it at that cost, as it would if our residual value was $1,000, then we would have $60,000 in equipment and $59,000 in accumulated depreciation, and it would just sit there. One thing that also can trip you up in your homework is you have to remove any account that is related to the asset if you sell or dispose of the asset. If you still have depreciation pending, you have to update your depreciation first, and then you remove those assets. So this is an example for our $60,000 machine. We disposed of it. It's total junk. We don't get anything for it. We take the $60,000 out of our accumulated depreciation, $60,000 out of our machinery. That piece of equipment is gone. It's off our books. If we assumed that the equipment had a cost of $60,000 and its accumulated depreciation is $50,000, the book value is $1,000 in this point in time. So if we junk the equipment, don't get anything out of it, this time we have a loss because our book value is $10,000. But the equipment was on the books for $60,000, and our debits have to equal our credits. So we had a loss on getting rid of that piece of equipment. So if I sell a plant asset, I can have a gain or I can have a loss. If my book value is less than the cash I received, it's a gain. If my book value is more than the cash I received, it's a loss. So I have an example here of we sold a piece of equipment for $7,300 cash. The equipment had a cost of $10,000 when it was purchased in January of 2011. It has been straight line depreciated with an estimated 10-year life and no residual value. Partial year depreciation must be recorded for the asset from January 1st, 2014 to the sale date. The depreciation entry at December 30th, 2014 is, so it was $7,300 cash that they paid for it. Oh, they sold it. It had a cost of $10,000. And it's been depreciated straight line. So it doesn't say it had a residual value. It says no residual value. So 10 years, so $1,000 a year. It was purchased in January 11, so it was depreciated 1,011, 1,012, 1,013, and now we need to allocate for January 1st through January 30th of 2014. How many months is that? Yep. And what's 9 times 1,000? What's 9? 3/4 times 1,000. $750. So to update my depreciation for September 30th, it's $750. So that means my cash receipt from the sale is $7,300. My book value is $6,250, and therefore I have a gain on my sale between the difference between the $7,300 and the $6,250. So to record this sale, I got cash of $7,300. I have to take my accumulated depreciation off the books with a debit because I need to zero that out. My equipment, I need to credit for $10,000 to zero out the $10,000 out of the equipment, and I record my gain as a credit because gains behave like revenue. So I always have to update my depreciation, keep that in mind. And then when I get ready to sell, my first step is to, again, update my accumulated depreciation. Then I record the sale. And it can be a gain or loss. If I exchange a plant asset, my entry, the only difference with this is I have to make sure I get my depreciation updated, and then I have to make sure that I get the old vehicle or asset off, the new asset on, and that I know what my fair value of my old asset and its book value is, so I can record that as a gain or loss. There's a quick example here, I think. Yeah. Quick example, and there is a homework problem about this as well. So if we trade in an old automobile for a new one with a fair market value of $15,000 and we pay cash of $10,000, the old auto has a cost of $9,000 and accumulated depreciation of $8,000. The implied fair value of the old car is $5,000. $15,000 minus the $10,000. So what did they give us for our old car? If we take our car into trade, we always want to know what they're giving us as a trade-in, and that's what we're looking at in this type of problem. It's our trade-in value. The book doesn't necessarily call it your trade-in value, but that is what you would be used to calling it if you traded in your car. And so we have our trade-in value or fair value of the old car of $5,000. The cost of the new car at delivery is $15,000. Then the fair value of the old asset, $5,000, plus the cash paid, $10,000. That's what we got for it. And they record the exchange by putting the new car on the books, getting the depreciation for the old car off, both debits, taking the old car off the books with the credit, and the cash that they paid out with the credit, and they had a gain. They had to have a gain in order to make their debits and credits equal, a gain of $4,000 on this transaction. And just some T accounts. We need to talk a little bit about natural resources. They are just things such as ore, oil, timber, anything that's on the earth or in the earth. You might frack for oil or natural gas, drill for oil, mine for coal or ore, and you log timber. The land is still there after all of this, but these are assets with physical use and they're depleted. You don't depreciate them. It behaves like depreciation, but it's called depletion. You always compute it like units of production, like you would compute units of production depreciation. You get it unit cost. If it's all extracted, if all of the extracted resource is sold, the entire amount depleted is recorded as an expense. If a portion of the extracted resource is not immediately sold, it becomes inventory. I might note this is a change in accounting methods. This is not how we used to record natural resources at all, but that's the way to properly record based on GAAP now. And so as instructors, we learn right along with you as GAAP changes. So this is illustrated in your book on pages 387 and 388, the actual process to buy this was to buy an oil reserve, and then the oil was drilled, so they had oil inventory and less in their oil reserve. And then when they sold their oil, they had a cost of goods sold and their oil inventory went down. And that's just the way you record it in today's world. Intangibles. Do you know, any of you know what an intangible asset is or what the word intangible means? I can teach you. Yeah. Blue says it's something you cannot touch. Something you can't touch or have, or I mean, patents is an example. So there is truly no physical form. You might have a piece of paper, but there's no physical form to the asset. It includes patents, as Shad said, and maybe someone else. It also includes copyrights, franchises that if you buy into a franchise, that franchise is an intangible. You pay a fee for it, and you actually amortize that off. There are two categories. They have finite lives, and if they have a finite life, then you use straight line method to record that amortization. It is called amortization expense, not depreciation. Same principle, only you use straight line. And then the intangible asset is reduced directly. There is no accumulated amortization account. So we would do amortization expense and credit our patent to reduce the value of a patent. There are also those that have indefinite lives, and we need to test those for impairment to see if they have a loss in value, and at that time we would write down that value if we determined that there was a loss. One thing that we need to also talk about is goodwill. Lots of times people aren't quite sure what goodwill is. Goodwill is the difference that you might pay for an ongoing business that is above the appraised value. And that is also something that is an intangible asset, but it only occurs if you purchase a pre-existing business. So here's a little bit of more information on the slides about patents. They are, of course, granted by the federal government. You have an exclusive right to produce and sell an invention, and they have a legal life for 20 years. You can buy patents from other companies, however, and then they may only have 5 years left or something like that, so you would definitely want to amortize them over the 5 years remaining. So we have some examples in the book and on the slides about recording for a patent that you purchase for cash, and then the amortization expense to straight line amortize that patent. And this company believes that the patent, it will only be good for 5 years, so they're not amortizing over 20 years, they're amortizing over 5, which they are allowed to do. Copyrights extend for 70 years after the creator's life. Their useful life is actually usually pretty short, but they are protected. Trademarks, you probably all know what trademarks are, but they can include advertising slogans. They can be set by contract. They can say that they're good for X amount of years, or they can be indefinite, good forever. Franchises, licenses, anything that you would do to have a license. Any of the sports teams, you buy bootleg shirts, or you could buy bootleg shirts that are illegal shirts because they were produced without having the proper license. And some things that, here's my goodwill slide then finally, but some things that people don't always think about as being an intangible asset are things such as customer lists or mailing lists. People will sell mailing lists to other companies, and that is an intangible asset. It has a life that decreases in usefulness over time because people tend to move and disappear. We need to talk a little bit about impairment, and this is something that, Blue was full of questions about what if something's not worth the value earlier in the class or the seminar tonight. And when we get to the end of the chapter, it starts talking about explaining the effect of impairments on the financial statement. So if an asset is impaired, we have to stop and analyze, is this asset impaired? And if we determine that the asset is impaired, then we need to look at the net book value and what the fair value really is. And then we need to record that difference as an impairment loss. Once I've determined my loss, then I do actually record it as a loss and reduce my long-term asset by that amount. And you will notice that I actually do hit my long-term asset. I don't hit an accumulated depreciation account at that point in time. Then I just have some basic ratios here that we need to look at. I say basic. Rate of return on assets is our net income divided by our average total assets. Remember, anytime we're looking for an average, it's our beginning plus our ending divided by 2. Our net profit margin ratio is our net income divided by net sales. What percentage of our sales actually end up in our pocket. We can increase this by increasing our sales volume, increasing our sales prices, or decreasing our cost of goods sold and operating expenses. My total asset turnover is my net sales divided by my average total assets. I can increase my sales and keep less inventory in hand. That'll improve it. Or I can close facilities, selling idle assets, and consolidating operations to reduce my amount of assets. And I think this is just pretty much a duplication, and I want to click through here. So if I want to know what my return on assets is, I need my net profit margin ratio, and I take that times my total asset turnover, and that gives me my return on assets, my ROA. Last thing is to look about how the cash flow is impacted by long-lived assets transactions. Depreciation, of course, belongs under the operating section. It is added back to our net income when we are reconciling items. The reason it is added back is because depreciation is a non-cash outlay expense. It's an expense we get to deduct off our income statement that really does not have any cash tied to it. So if we are reconciling for a cash flow statement, we have to bring that portion of the operating section back to cash basis. In order to do that, we have to add back any non-cash transactions that were subtracted. We would also subtract off any non-cash transactions that were added, such as gains. Any sales of our long-lived assets would go under the investing activities on the cash flow statement. If I sell a long-lived asset, I bring in cash, so therefore I have a cash inflow. If I have a purchase of a long-term asset, then that's also investing, but I am spending cash if I pay cash for it. So therefore it is a cash outflow. So that would be subtracted from my investing section. This is just an overview of looking at how it affects the cash flow, because we will get to cash flows, and we don't want you to get there and just think, I've never seen anything about cash flows in my life. So that's the end of the slides. Do you have any major questions? Would you like to see some examples of depreciation methods, or do you think you have it? Okay. I have one person who wants an example. You're all free to, you don't have to stay if you don't want to stay, but someone did ask for a few examples, and I did go through the quiz just a little bit earlier this evening. I actually got home a little earlier than I usually do, and so I spent a little bit of time working through quiz questions and looking at the homework. Okay, if I'm going to do straight line, I think, does everybody have straight line? Okay, so straight line, I think we're pretty good. I have some questions, specific questions about units of production. So if I have units of production, we'll look at that one. So let's just make up a simple example. We have something with the cost of $10,000, and we'll say $2,000 residual, and we'll say a 4-year life, um, 100,000 hours. Used 1 hour, or let's see, 100,000 hours. In the first year, we'll say we used 3,000 hours. Let me make sure that totals my 10,000 hours here. It's late at night. Yep. Okay. Okay, in this case then, this is a pretty little easy numbers to work with. So we would first have to determine our unit cost. So in this case, it's going to be 10,000 minus 2,000. Oh, I can just do it this way. Divided by 10,000, or the total number of, well, there I just did that. That was supposed to be 100,000, so I need to make this 30. Sorry. No, it's 10,000, isn't it? I can't see. Undo. Okay, divided by 10,000. What I need to do is put commas in. Okay. So to get my unit cost, that would be the formula. Cost minus residual divided by the number of hours. So that would equal 80 cents per hour. Okay, so that's my unit cost per hour. Once I have my unit cost per hour, I just take it times my amount per year. So my depreciation expense, accumulated depreciation, and carrying value or book value. I can do those numbers all relatively easy here. I'm going to do my 3,000 times 80. That would be year one. Year two is 2,500 times 80 cents. Year three, and year four, okay? And then to get my accumulated depreciation for my first year, it's just that amount. This is the first year's depreciation amount. My book value is actually my cost minus my 24, or my 10,000 minus my 2,400. Year two, I have accumulated depreciation of the 2,400 plus the 2,000. My book value, I can do it one or two ways. I can take my 7,600 here and subtract my additional 200, or I can go back and do my 10,000 minus my 4,400, my accumulated depreciation. So just continue to add my years on. Plus 10,000. Okay, to end up with my book value of 2,000, which was my residual value. Did that answer your question? So that's units of production. Did that help? Okay. Anything else that you specifically think of? The only thing that this one was an even amount, and so we didn't run into that difference, but this was where I was warning you that in the last year on one of your homeworks, due to rounding, you've got to watch this. It's actually your amount for your depreciation expense in your last year. You've got to watch this so that you make sure that you end up with your book value being your residual value. Yeah. Yeah. How are the estimated usages projected? As far as this 10,000 hours is what I'm assuming that you are talking about, because the hours, the 3,000, the 25, the 4,000, those would be actual hours during the year. Okay, those are going to be actual hours. So if I was going to use, if I'm using hours and I've got some kind of a machine that has an hour meter that's going along, just if I'm using miles and my car tracks miles. So my actual yearly amounts are, right, it's actual. The estimate comes in with the how many hours I think it's going to use total life. So my estimate in this example for units of production is my cost per hour. That's truly my estimated amount. Once I have that amount, my actual hours or my actual miles would be used for each period. Okay, good. Because sometimes I think, yeah, when you look at the problem and they're giving you all these numbers, you're just thinking, well, how do they know that? And they don't. Those are actual. It would be at the end of this year, this many were used. Anybody have any other specific questions? I know, Melinda, you had gotten pretty far on your homework, does it? But you said, was there something specific that you saw else that was a problem? Okay, Melinda, if you run across the specific question, and I did look at those, I just don't want to pop them up here in front of everybody, and I know. Melinda's sleepy. I don't know. What, have you been up probably since 5 this morning, Melinda? Yep. I know, and I feel like I sound like my voice sounds like it's gone, and I'm not sick or anything. It's just tiredness too. So, all right. I think everybody works long, hard days in this world, and we all put in a lot of long hours. So if any of you run across any specific questions, don't hesitate to email. Try to get started on your work early. I know that it's hard to do that sometimes, but you're just setting yourself up for failure when you wait till the last minute to attempt something, because you just can't ask, and there are a few things in here that you may want to ask about. So if that's it, then I'll see you all next week. Don't hesitate to ask, okay? You're welcome, Rebecca. You too, Blue and Melinda. Have a great night, okay?